Investments you think you've won, but actually lost. In investing, not all gains are what they seem. Sometimes, investors feel like they are winning, seeing profits, following trends, or timing a rally, yet their real outcome is a loss once costs, taxes, inflation, or opportunity cost are considered. These are often called illusory gains. 1. Hidden costs erode gains. Investors often ignore the full cost of investing. These hidden factors can turn apparent gains into real losses. Transaction fees. Frequent trading fees reduce net return. Taxes. Capital gains taxes on profits shrink real earnings. Slippage. Buying/selling at less favorable prices than expected. Management fees. Mutual funds or advisors can quietly reduce returns. Example: a stock rises 10%, but after 2% fees and 3% taxes, your actual gain is 5%, less than it seems. 2. Inflation and purchasing power. A 7% nominal gain may feel positive. But if inflation is 8%, the real return is negative. Economist Milton Friedman emphasized that nominal gains are deceptive without considering purchasing power. Investors may celebrate profits that are actually losses in real terms. 3. Opportunity cost. Even profitable investments can be a loss if the capital could have earned more elsewhere. Holding low-performing assets while markets rise. Missing high-return opportunities due to fear or inertia. Allocating to safe assets that underperform inflation. Real gain is relative, not just nominal. 4. Behavioral illusions. Behavioral finance shows that human perception of gains is often biased. Disposition effect. Selling winners too early, holding losers too long. Mental accounting. Treating paper gains as spendable wealth. Overconfidence. Believing skill when randomness explains returns. Richard Thaler notes that these biases can make investors feel successful while their net result is negative. 5. Risk-adjusted reality. High returns can disguise extreme risk. For example, leverage can produce short-term wins, but catastrophic long-term losses. Concentrated bets may spike, then collapse. Timing the market may create temporary gains that vanish. Good investing measures outcomes relative to risk, not headline returns. 6. Real-world examples. Buying a volatile cryptocurrency at a peak shows huge short-term gains, but crashes before selling. Leveraged ETFs can gain 20% in a week, but lose more than that over months. Frequent trading. Profits offset by taxes, fees, and miscompounding. In all cases, the perceived gain does not match actual wealth creation. 7. How to avoid illusory gains. Calculate net, risk-adjusted, and inflation-adjusted returns. Factor in all costs, fees, taxes, slippage. Compare to long-term benchmarks and opportunity cost. Avoid emotional attachment to short-term gains. Focus on process, not just outcome. Conclusion. Feeling rich doesn't equal being rich. Investments that seem profitable can hide real losses. True success comes from accounting for costs, measuring real returns, evaluating risk-adjusted outcomes, staying consistent with long-term strategy. In investing, perception is often misleading. Only realized, net, and sustainable gains matter.